Hello. The National Business Information Clearinghouse and Entrepreneurial Development Center welcomes you to our Beginner's Guide to Financial Statements. This module focuses on the balance sheet, also known as a statement of financial position. What is a balance sheet? A balance sheet is a snapshot of a company's financial condition at a specific moment in time. What does the balance sheet show? The value of what the business owns, the amount of debt the business has, how much inventory is on hand, and how much money the business has to work with in the short term. A balance sheet helps a small business owner or potential lender quickly get a handle on the financial strength and capabilities of a business. The balance sheet is divided into two parts that are based on the following formula: assets equals liabilities plus shareholders' equity. The sum of these two sections must be equal. They must balance. Now let's discuss each of the elements of the balance sheet. Assets are anything a company owns that has value. Assets can be divided into three categories and are generally listed based on how quickly they will be converted into cash. Current assets are things a company expects to convert to cash within 1 year, such as cash, accounts receivable, inventory, and merchandise. Fixed assets typically cannot be converted into cash easily, such as land, computer equipment, buildings, vehicles, and furniture. And long-term investments and other assets include intangibles such as goodwill, patents or copyrights, and stocks or bonds that the company intends to keep for more than 1 year. On the other side of the balance sheet are the liabilities. Liabilities are the amounts of money that a company owes to others. Liabilities are generally listed based on their due dates and can be either current or long-term. Current liabilities are obligations a company expects to pay off within the year, such as accounts payable, notes payable with a collection cycle of less than a year, or any payroll that is still owed to employees. Long-term liabilities are obligations due more than 1 year away, such as a 10-year business loan. On the same side of the equation is shareholders' equity, which is sometimes called capital or net worth. Shareholders' equity is the amount owners have invested in the company's stock, plus or minus the company's earnings or losses since inception. It's the money that would be left if a company sold all of its assets and paid off all of its liabilities. This leftover money belongs to shareholders or the owners of the company. What does the balance sheet look like? Here's a simplified sample showing 3 different sections previously discussed: assets, liabilities, and shareholders' equity. It's time to test yourself. Answer true or false. A balance sheet is a snapshot of a company's financial condition at a specific moment in time. In order for the balance sheet to balance, total assets on one side have to equal total liabilities plus shareholders' equity on the other. Assets can be divided into 3 categories and are generally listed based on the due dates of money owed. Current liabilities are obligations due more than 1 year away. Shareholders' equity is the company's total net worth. Congratulations! You now understand the elements of a balance sheet. For more information about this topic, you can visit one of our customized business information clearinghouses. These websites give you access to a variety of free resources for starting and growing your business. Click on the EDC button to view additional online training topics, including the entire Beginner's Guide to Financial Statement series. Thank you for visiting the Entrepreneurial Development Center, presented by the National Business Information Clearinghouse, the world of business, translated. This program was made possible by the generous support of founding sponsor, Western Union.